So many times I'm being asked, what's the best way to get started investing? And that's a great question because there's so many great options out there. It can easily be overwhelming. One day you read about Bitcoin, another one about stocks, then bonds, and so many various other things that you could possibly invest your money in. So whether you're investing beginner or you already started investing but want to get a recap on different asset classes that you can possibly invest in, then this video will hopefully be useful for you. And in this video, I'm going to be reviewing all these various options that you can see over here. The ones on the right, I'm investing myself. The ones on the left are also options that I'm not actively investing, but you can if you want. And I'll talk to you about the various pros and cons of each of them. But before we dive in, let's quickly recap what investing really is. Essentially, it's nothing else but using your own hard-earned money to invest into something that will generate you more money from it, making your money work for you. And that can either come in the form of income that you get from your investments that is paid to you on a regular basis, or through capital appreciation, which basically happens when you buy something at a lower price, you hold on to it, and after some period, the amount that you can sell it for is higher than the amount that you paid for it initially. So that's the capital appreciation. Now, for me personally, I like to invest in things that have both an income component and a capital appreciation component, because only one for me, it's lacking something. So I like to combine both of them, and you will see some of those investments offer actually both of those. Now, the first and probably most famous one that everybody talks about, you read it in the news, you see it on TV, are stocks, right? We always hear stocks are going up, stocks are going down, it's a bull market, it's a bear market. So there's a lot of terminology which I don't want to overwhelm you with, because sometimes, you can get caught up in all these terms and then get scared away. Actually fairly simple. The stock market is a market of stocks. So stocks are basically shares in individual companies that you can buy as an investor and, become almost like an owner. You have a share, a percentage of ownership in the company, and that way you basically become an owner in the company and will benefit also from price appreciation if the stock increases in value over time. Now, within stocks, there are differences. Probably most popular in recent times are ETFs, exchange traded funds. And that's an amazing way to get into the stock market without having to do your own research as to which company you want to buy. Because sometimes beginners say, well, I don't know what to invest in. There's so many companies out there, which one to pick, right? That's a good question. And traditionally, to be honest, individual stock picking underperforms investing into a market. And that's what ETFs help you to do, to invest your money into a market, into a certain set of indexes. So if you want to invest into index, you need to have an ETF, because you can't just invest yourself into index, you need to have an ETF for that. And indexes are basically a collection of various stocks within a given parameter. So for example, you could have the FTSE 100. These are the 100 biggest stocks on the London Stock Exchange. Or arguably the most famous index in the world is the S&P 500, the 500 biggest companies by market value in the United States of America. Now, that's something I personally invest in, and I always recommend beginners to invest in that, because honestly, you can't really go wrong, right? You have all the big companies such as Apple, Microsoft, Google, Amazon, Netflix, Meta, you name it, all of them are there. And you can't really go wrong. And they're by nature diversified, because all those companies operate on a global scale. Yes, they happen to be based in the US, but technically they operate globally. So if they have a booming business in China, they will benefit from that. So you as an investor into that will also benefit as a consequence from that. And you don't have to individually pick your stocks, because if one company is not anymore the 500 biggest, it will fall out of it and another one will come in. Otherwise, you would have to do your own research. That way, it's done for you. So you could invest into an ETF, which in my case is the WUSA, is one of the popular ETFs out there. It's from Vanguard, it's one of the providers. Arguably, two of the biggest providers out there are Vanguard and BlackRock. Both of them are very good, and you should always look at the expense ratio, because some of them can be very expensive. That's basically the management fee that you pay to those companies for managing the ETF on your behalf. Currently, I pay around 0.07%, but I have seen ETFs up to 0.5%. And that takes away from your income, right? If you only earn 2%, all of a sudden you only earn 1.5% return, right? So it does make a difference. So in my case, I love the WUSA. You can just look it up on your broker of choice. It's a great way to get invested and started with the S&P 500. You don't have to worry about anything. You can set up a saving plan where every month you just continuously buy a certain amount of money, and then you get an equivalent amount of shares in that ETF. And honestly, you can't go wrong. That's how I started with, and I always recommend for beginners, probably the best way to get started. With this, we move on to growth stocks. Now, these are stocks that we all read about in the news, because these are exciting stocks where we see big swings, a big growth or big decline. They're always in the news. For example, Apple, we have Microsoft, we have Nvidia. All those companies are growth stocks because they have a high growth trajectory. And honestly, those companies are probably the top 10 companies in the S&P 500 anyways. And if they do well, the S&P does well. If they go down, you will see it also reflected in the prices of the S&P 500. So these are companies that are very hot. Everybody talks about. They have a high liquidity because a lot of people internationally invest into those and want to participate in their gains ideally. Now, usually those companies don't pay a dividend because they are still growing very much. So they're reinvesting any profit into growing revenues further. So if you want a dividend, then usually those companies are not the best. But if you want to have price appreciation, so here we go back to the point of capital appreciation, then that can be very good. Now, going back to the ETF, different ETFs have both components. They do have a dividend and they have capital appreciation. So that can be good for you. In the case of growth stocks, you usually only benefit from the price appreciation or capital appreciation from your investment. So if you invested 1,000 euros a year ago and today it's 1,500, then the 500 euros difference is your capital appreciation. And that's also the part you're going to be paying tax on in case you sell it. With this, we move to one of my favorite stock investing class, and these are dividend stocks. So these are basically companies that pay me a dividend for owning the stock. So I become a part owner, and as such, I get a share, a cut from the profits, which is really nice because that way, all those thousands of people, they're working for me essentially, right? Obviously in the beginning, you might have a very small share and therefore a very small dividend, but it can really start adding up. And you could invest into, for example, companies such as Coca-Cola. They have been paying a dividend and growing the dividend for the last 61 years. So that's quite a long period if you think about it. And not only that, they also organically increase the dividend year over year, which is really amazing. Another popular one is Realty Income, which is a real estate investment trust, which basically is a huge landlord of real estate in the United States, and a company I personally invest in myself as well. They pay me a monthly dividend, and that's currently around 6%. So that's really good. 6% of your invested amount you will get as a dividend. Obviously that's per year, but it's paid to you on a monthly basis. So it's really attractive. And some of the dividend stocks I have in my portfolio, they have a dividend growth rate for the last 5 years, meaning every single year for 5 years in a row, increased the dividends by 10%. Now you have to ask yourself, do you get a 10% year-on-year increase in your salary for the job you're doing? Most likely not many of us do, but here you get it just by owning shares and stocks in the company. So for me, dividend investing is really attractive and something I'll continue to grow, and that's when you start seeing a compounding. In the beginning, it's very little amounts, but in the future, the dividends I get, I reinvest into buying more shares, and the more shares will pay me more dividend, and it's kind of really starting to snowball, so to say, and really starting to become quite an attractive income over time. Just 2 years ago, I made 14 euros per year in dividends. Right now, I just crossed 1,000 euros in dividends per year. And honestly, by the end of 2024, that number will be significantly higher once again, because I will continue to buy more dividend paying stocks. With this, we move to another very popular investing class, and that's of course cryptocurrency. It's very popular, right? Whenever the markets are up, we read about it in the news, but at the same time, if the markets drop, everybody says, we knew crypto is going to go to zero. And honestly, I'm not here to give you any investment recommendations. These are just options out there for you to invest. Now, naturally, cryptocurrency has a much higher risk by nature than a company, right? A company such as Apple is not going to disappear tomorrow or drop by 50% in value. It's highly, highly unlikely. Now, crypto, on the other hand, is much more likely to either go up 50%, but also go down 50% in a matter of weeks or months, right? It's much more volatile. So it has higher risk, but also potentially higher rewards. Now, I invested in crypto since a few years, so I also benefited a lot from the price appreciation. And you can also get an income. If you want to stake your cryptocurrency or lend it out, you can get passive income, but mostly people use it for capital appreciation in most cases. And obviously the most popular one of the various crypto coins out there is Bitcoin, which is also the one I believe in the most, is the granddaddy of cryptocurrency, so to say, is the most established, the most trusted by now. And that's something I invest in. It's actually the biggest part of my portfolio, not by design, but actually it grew in value quite a bit. So that's why it became. Right now, I'm not buying anymore, but I'm really happy with it. And I believe long term, the value will only go up. Even though short term, there might be swings, there might be further drops, but 2, 3, 4 years from now, I can't imagine that Bitcoin will be significantly less in value than it is today. But of course, there are also many other coins. They call them usually altcoins, alternative coins. And here I would even classify Ethereum and many other meme coins that came and went. Obviously, Ethereum is more established, but a lot of the meme coins, whenever we have a bull run and prices go up, then anyone is coming up with their own coin. They pump them and then they drop. So honestly, this is not something I invest in. That's like investing into a company you know nothing about, just throwing your money at it and hoping they will do well, because it's not difficult to come up with your own coin and sell it somewhere. But a lot of the projects are really scam projects and not something I'm interested in. I'm a long-term, more conservative investor, I would say. So for me, I'm really happy with Bitcoin, and that's all for cryptocurrency, because by nature, cryptocurrency is already very risky, and I personally don't need extra risk on already a risky investment asset. Then we move to another category, which I call interest income, even though it's hard to really call it an investment, because here you don't really get capital appreciation, right? If you put 1,000 euros into an interest-bearing account, you only get interest on that 1,000 euros. You won't have a capital appreciation. So the 1,000 euros by itself won't be more after 2 years of keeping it in the account. You only have more because you got interest income. So it's still much better than keeping it at a bank where you get zero in many cases. But I still wanted to mention here, because if people feel uncomfortable with any of the other options, I still think it's a good way to make sure you get the highest amount of interest you can possibly get on your money, rather than just keeping it in cash, either at home in your safe or in the bank, as I said, at 0 or 1% interest. There, you're really losing out to inflation. And the great thing is, right now, there's so many great options out there. I have a number of brokers and apps that I'm using for this. For example, Trade Republic, where you get 4% interest paid to you every single month right into your account, which is really amazing. I can withdraw at any time. There's no lockup period. So that's something also for you to check. In your bank, sometimes they give you a high percentage of interest rate, but you need to commit to keeping it there for 1 year or 2 years. And honestly, I don't want to do that, right? Because I don't know what's going to happen in 2 years. Maybe I see a great investment opportunity, or I have an emergency where I need the money, or I see a property that I want to buy and I need the money for a down payment. So there's so many question marks. So why do I need to lock it up for such a long period? And with all of them, such as Trade Republic, Revolut, and Lightyear, these are some of the ones I'm using. There's no lockup period, my money is protected, and I get very juicy, high interest income. And for me, that's really exciting, interesting, and definitely some part of my money that I have, I keep with that. And in most cases, this is my emergency fund. And I always recommend people to have an emergency fund on the side before you start investing. Because if you don't have any money for emergencies, you're going to have to sell your investments. And maybe the investments right now are dropping in value. So then you're selling at a loss just to have the money. So first of all, before you start investing, have an emergency fund. Some people say 6 up to 12 months of your monthly income to have it parked on the side. So if you earn 2,000 a month, have up to 12,000, let's say, on the side in the account, ideally in an interest-bearing account without any lockup, and you should be good to go. Anything on top of it, you can then invest into any of the other asset classes we're talking about today. And from that, we move to the last investment class that I'm currently investing in, and that is real estate. Now, I do understand that real estate can be a little bit tricky to get started investing in. Stocks, crypto, and all the other ones we discussed before, you can start from as little as 10 euros basically you start investing, right? But real estate, you need some money to get started. So I understand that this is not for everybody, and some people might choose to just rent because they don't know where they want to live in the future. So why to own a house or apartment if you're young? And I totally understand that. It's definitely not for everyone, but I still think in terms of overall returns, in my case and in many other people's ones, historically, real estate can be one of the best investments you can do. And in my case, it actually has been showing me the highest returns that I have so far came from my real estate investment. So I'm really happy with that. But once again, if this is too much for you to get started, especially if you're young, beginning, then probably stocks and crypto might be an easier way to get in. And later on, you can always add real estate. And in there, obviously, I can make a whole video around that. But there are things such as the purchase cost of the apartment is very important, right? You need to see how much you can actually afford versus the market value and future returns. That's the idea, to have future returns from your investments, right? Then you need to look at the financing cost of the mortgage. Right now, we're in a very high interest environment. I just showed you that you can get 4% interest on your savings, but that also means you're going to be paying well above that. In my case, I pay close to 6% right now for the mortgage that I took from the bank. So that's very expensive when you think about the amount that you have to pay every single month just in interest, basically for the bank to lend you the money. So hopefully that will go down in the future, it gets cheaper, but that's something really to consider as well. Then we have the cash flow yield from the rent. And that's very important, especially if you do it as a pure investment. You can either buy a house or an apartment for yourself, or you can buy it to rent it out. That's what many people do, myself included as well. And basically my goal is to have the rent be higher than all my financing costs. So whatever I pay for the mortgage in the month, let's say 1,000 euros for the mortgage to the bank, I want to make sure I get more than that in rent, ideally 1,500, let's say, so I can pocket those 500 and have them as an income. And at the same time, the tenants will pay off my mortgage over time, and in a few years, I'm without any mortgage and I fully own the property, and that's mine, right? So that's really, really attractive, and that's something you have to run the numbers later on. But once again, I could probably make a whole video about this, and I'll do so in the future. If you want to know, let me know in the comments below. And lastly, of course, we have capital appreciation. So even if you don't want to rent it out, you live for yourself, that's still very important and goes back to the purchasing cost of the property. So if you buy a house, let's say for 250,000 euros or dollars, whatever you have, you ideally want in a couple of years this amount to be at 300, 400,000 to have appreciation. So that's the profit that you make from the property. Obviously, you're still going to have to pay the tax on it, etc. But you want to see the capital appreciation in case you don't have any cash flow coming in the form of rent. So it is much more complex than investing into stocks or crypto, but definitely the upside can also be tremendously high if you buy the right property. And that's also important, similar like with stocks, to find the right company. Here, you want to find the right property. Right, with this, we move to some more investment classes that I'm not currently investing in, but they are very popular. And the first one is bonds. You might have heard about bonds in recent times. This is really popular. It hasn't really been available for retail investors like you and I in the past. It is more difficult to invest in. But now, with the rise of neo-brokers, once again, such as Trade Republic, it becomes easier to invest into bonds yourself. Bonds are basically forms of debt. These can be corporate debt or government debt. Government debt can be basically countries. United States, for example, they need to have more money to finance certain things in their country. They will issue debt and you can buy the debt from them in return for a guaranteed interest rate. That's essentially what it is. The same for companies. A company such as Porsche, for example, can issue debt. They want to raise money, but they don't want to do it through the stock market. So they want to raise money. So they get the money from all the people, such as you and I, in return for a guaranteed amount of interest that they pay you, and that's for a certain amount of years that is stipulated in the bond. This can obviously vary, the length of the agreement can vary, and the interest rate can vary as well, but there won't be capital appreciation. So they will basically repay you the amount that you gave them. Let's say you gave them 5,000 euros. At the end of the period, after 2, 3, 4 years, depends on the term, you will get your 5,000 euros back, plus the interest rates that have been agreed to you. Now for me, that's not really exciting, because for that, I have my interest income that I get from my brokers. But obviously, as the interest maybe comes down in the future, some people might find bonds attractive because usually you can lock it in for a longer period. But as I said, I don't want to lock my money in, right? Even with stocks, I can sell them at an instant notice and have the money. The same with crypto. I'm very liquid with all my investments, except for real estate. That will take longer. But generally, I'm not the biggest fan of bonds. They are generally regarded as more safer, long-term investment vehicles, but especially for younger people. Personally, I don't think is the best investment opportunity for you. Then we move to commodities, and some of the biggest ones is obviously gold and silver. Now, a lot of people say you should buy gold because it's an inflation hedge. And I totally understand that gold can make you feel safe because you never know what might happen. You have your gold and you feel good about it, that your money is locked in. Now, I don't know about you, but I'm a digital first person. I like everything digital. I like to have it on the go with me. I want to see it on the screen. And I personally don't want to be bothered having to lock up my gold, wondering if it's safe at home, if something happens, if somebody breaks in, steals it. And at the end of the day, what can I really do, right? It's not like I can go to the grocery shop and buy my food with it. So personally, for me, gold is really not appealing. And even when I see the returns over the last 10 years, we're talking about 64% increase, which is really not that much. I mean, if it was a stock, you would really say it underperformed the market big time. Now, understand it has different investing purposes. So if it works for you as a store of value, so to say, then definitely that's fine. You can buy it through your bank. There are different ways to acquire it. You can buy it physically. But once again, for me, I really don't like it and it's not something I'm going to invest into. Then we move to another popular investing asset in recent times, and that's P2P lending, where you basically become the bank to some people who want to borrow money from you. And these are platforms that you can sign up to, and basically they allow people, anyone, to borrow money, and the platform will match the borrower with the person looking to borrow money and link them up. In return, you, as the person borrowing the money, you will get a high interest rate, sometimes up to 12% annually. So that's really attractive. Now, at the same time, having said that, there is a high risk of default because basically there isn't much checking of the person borrowing, right? When you go to the bank and take a mortgage, for example, what I did in my case, I mean, I was screened all around. They really took everything apart and made sure I'm really worthy of that credit, and I have securities to back it up in case I don't pay. They have my house to take, etc. So a lot of things. Here in many cases, you just sign up, you say I need the money, they do a very quick background check, but basically, really anyone can take the money from there. And that's why you need to have a higher return, because a lot of those loans never get paid back and then you lose out big time. So in my case, I did it for a while. It was nice to get a high interest income, but again, this is not guaranteed and you might risk your principal, your capital completely. So for me, it's not something I'm really excited about, especially now when I get 4% risk-free. Those 12% with the potential of losing out, it's just not attractive for me, especially considering that the S&P 500 over the last 20, 30 years returned 8 to 9% per year over that period. So why not to go with the S&P 500, where you're much more likely to get the return rather than here. And lastly, we come to alternative assets or collectibles. These are things such as watches that people invest in, fine wines, or even fine art. Now, these are alternative investments because it's not so common, right? There are specific platforms for that help you invest, even to crowdsource, where people, hundreds or thousands of people can buy famous paintings. You pay a fraction of it. And in a way, it's similar like buying a share in a company. Here you buy a little share of a painting or a share of an expensive bottle of wine that over time appreciates in value. Once again, you won't have income from that. They will only pay you the capital appreciation if it goes up in value and one day you decide to sell. So from the buy price to the sell price, that difference is what you make in profits. But honestly, I'm not really an expert in any of those. I don't have any idea about them, what is good, what is bad. So for me to invest my money in it, I would just blindly follow what other experts are saying, and I really can't do much research. And once again, I like to see the companies, companies that I invest in, I follow them myself. I see the revenues, I see their profits. I'm really excited about their quarterly results and participate in it. A painting, you just buy, you might look at it once in a while, but then you just hold on to it for a couple of years and hopefully one day it has a higher price and you can sell it. But yeah, for me, it's not really, I'm really excited about and I won't be investing in, but I know a lot of people who did and made good money from it. So it really depends on you. Now, of course, there are still way more investment asset classes out there, such as investing into different currencies. You can option trade, there are mutual funds, or CDs that you can also buy and sell. So a lot of options out there that I haven't touched on, but these are probably the most popular. But if you're just starting to invest, then honestly, this will do the job for the majority of people. I'm invested into some of those and I'm not planning to add any of those really risky ones in the future because I'm a really long-term conservative investor and I'm really happy with what I have so far. I hope you found the video useful. If you still have any questions about any of it, let me know in the comments below and I get back to every single one of you. Next up, check out this video over here where I'm going to run you through the process of how I'm buying my stocks. As always, stay healthy, get wealthy, and I'll see you in the next one. Ciao.